You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again. It is Thursday. It is noon Central. It is 1:30 p.m. Central. It is 2:30 p.m. Eastern. It is time once again for TWIFO, This Week in Futures Options, the program where we break down everything going on across the broad spectrum of products trading over there at CME Group. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever scintillating, ever educational, ever informative Options Insider Radio Network. I want to thank all of you who've continued to pile into TWIFO from the end of last year into the beginning of this year. Love to see all the new earlobes joining us here on the show. Remember, if you like what you hear, do keep rating and reviewing. Really does help the new folks continue to discover the content. And of course, if you want to discover even more content in your life, and hey, who doesn't, right? Then you know where to go. There's only one place. theoptionsinsider.com/pro is the place to go to kick the tires and light the fires on all the great stuff we have available over there. There's 2 exclusive shows, Pro Q&As, where we pick the brains of some of the best minds in the world of options and derivatives, as well as Options Oddities, where we break down all the madness from the week that was from an unusual activity perspective. Of course, the entire Pro podcast feed at your fingertips, nearly 200 hours worth of content and more coming all the time. Giveaways, just gave away our Pro Trading Crate, so look forward to get your name entered into the hat for the next one, as well as, of course, live access to everything we do and a whole bunch more. theoptionsinsider.com/pro is the place to go. As we go on over to the CME Group Hot Seat, see who's joining us on the program today. I am pleased to welcome back our old friend, Mr. John Brady, the Managing Director of Global Institutional Sales over there at RJ O'Brien. John, welcome back to TWIFO, sir. It has been too long.
Thanks, Mark. It's good to be back. You're nice to have me.
You know, John, this is your first time joining us here so far this year, of course. So let's start taking your pulse, your survey. We've been doing this with all of our guests so far here early in 2023 here. In fact, looks like you haven't joined us in almost exactly a year. Is that right? Did you last join us February 10th of last year. Is that even possible, John?
No, Mark. I was with you guys in September, October, and November, late part of 2022.
I don't know. That's what my producers are telling me here. They're whispering. Maybe they mean the Pro Q&A hot seat, but on this program, maybe the last time you were on.
That's it. That could be right.
Either way, it's been quite a while, John. So let's start there. We're asking all of our guests here, now that we're into this hot and heavy 2023, when you look back at the equally, if not more so, hot and heavy 2022, what really stands out to you from a market perspective, sir?
Well, this is the return of interest rate policy globally, right? I mean, savers are now rewarded by, having things like, money market funds and CDs and savings accounts and things like that. So it's been sort of it's been a paradigm shift, from a disinflationary, borderline deflationary world, which lasted maybe a decade, maybe a little bit more, in terms of interest rate policy. And now, we've got interest rate policy. We have upside, pressure and potential for interest rates as, central bankers try to slew the inflation dragon, which has really sort of popped up from an overly stimulative fiscal policy put forth by our beloved politicians, and so that's got led itself to volatility and steeper curves and more inverted curves or curve movement and stronger currencies and a repricing of risk and risk assets and tighter labor markets and tighter profit margins and a repricing of equities. And it's been it's been a paradigm shift, and it's been a kind of a welcome shift by those who were kind of almost like dinosaurs and have been selling interest rate derivative product for the better part of 25 years.
That is the case, sir. And it's also the case that it is time to keep on rolling right on into the Movers and Shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers report.
All right, everybody, welcome to the Movers and Shakers report, the portion of the show we break down everything lighting it up to the light side, a.k.a. the upside, and to the dark side this week over there at CME. If you want to see this report for yourselves in your hot little hands, give a follow over there to CME Group on Twitter, or you can follow us at Options on Twitter. We all put it out right before showtime. It's pretty much the only premium report you can get your hands on over there at Bantix. Otherwise, go check on out Bantix.com, Bantix.com. While you're there, sign up for the free trial. You can get access to this and all this other. I mean, we really do just scratch the surface of the legions of reports and data they have over there available at Bantix.com. So if you're not checking it out, you're intrigued by these markets, you're doing yourselves a disservice. Bantix.com, the place to go to kick the tires and light the fires. And Mr. John, where should we go this week? Where should we begin our journey, sir? To the light side or to the dark side?
Let's go with the light side, Mark.
A good choice because there's not much of it this week. It's one of those biased weeks, shall we say, John, where it's mostly one direction. And in this case, listeners, it is mostly red. In fact, we can do a top 5. In fact, we can even do a top 6, but that's pretty much about it. That shows you how much red is on the screen today. But we'll get there in a second. First, to the light side we go. Number 5, one of our 3 frequent offenders managing to sneak in here yet again this week. It is NatGas. It is pretty much a little more than unched on the week, but it's enough to make it into the top 5 this week, up 0.41%. To give you some frame of reference, listeners, it was number 2 in the other direction last week, off about 9.25%. That's more along the lines of the moves we've come to expect out there in NatGas. Plus 0.4, that's a rounding error, but it's enough to make it into the top 5 this week. Number 4, feeder cattle. Again, lazy week to the upside, listeners. Up a whopping 0.63%. Number 3, we have Brent up about 1.5%. It was number 5 in the other direction last week. Last week, a rough week for energy, off nearly 5% last week. Number 2, rough rice. So clearly it is not a rough week for rough rice out there, listeners, up 2.05%. And the number 1 light side mover, such as it is, not really with a bullet, more of a BB. It's WTI up 2.6%. It was number 3 in the other direction last week. Again, the energy apocalypse last week off nearly 6%. So clawing some of that back this week, but not much. Speaking of the apocalypse, listeners, man, they are just coming for the dark side this week. We could do a dark probably 30 plus if we really wanted to. But we'll cut it off at 5, listeners. Number 5 product John may be a little bit familiar with. This is our old friend, the 3-month SOFR, off nearly 6% this week, 5.97%. So that gives you some frame of reference. We top out the light side up 2.6%. And just to break in to the dark side this week, you got to be around 6%. So that shows you how much more red there is on the screen and how much more severe it is. Number 2 of our 3 frequent offenders, it is Bitcoin, off 6.12%. Number 3, back to the metals, it is silver, off 6.25%. Number 2, still hanging out in the metals, it is platinum, off 6.8%. And number 1, there it is, our other friend, our other frequent offender, the trifecta is back, listeners. It is lumber, off a whopping 13.88%. Yes, once again, dead trees, the most volatile thing on the planet. It was number 4 in the other direction last week, up 3.75%. So again, a rocking couple of weeks for dead trees out here as well. All right, we got a lot to sink our teeth into, John, but I know you like yourself a little bit of rates, and we just are coming off the heels of the Fed last week. Then, of course, we had Powell chatting again this week. So I think we have to start out there in the rates first.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, everybody, welcome to the world of rates. You guys know where to go to find all this data for yourselves. CMEgroup.com/TWIFO. That's where you get access to the free version of the TWIFO reports. Of course, if you want to upgrade, see all the other data, bandtix.com, the place to go. Once you're at that drop down, listeners, pop all the way down to the interest rates column. That's going to take you down about 6. And then we'll hang out in U.S. rates. Where we go from there is anyone's guess. But John, as I mentioned, you spent a lot of time, you're not talking to me over there in the rates complex. A little bit of action on that front over the past week. I'm not sure if you noticed, but your buddy, Mr. Powell, shaking things up over there. I know in the past when you've been on the show, you were, shall we say, not overly enthusiastic about the job the Fed has been doing over there. What are your thoughts on what the Fed said last week? And then, more importantly, perhaps, the market's reaction to it, sir?
Well, Mark, I'm not quite sure it was so much what the Fed said as much as it was the data. So on Friday, we saw some extraordinary data coming out of the month of from the January employment number, which showed more than 500,000 jobs being created within the economy, and the labor market tightening, the unemployment rate getting down to 3.5%, and it was just an all around much stronger number than market expectations. And then that number was followed up by the service sectorism report, which was much stronger as well, and that bounced back from sort of a 1-month December 2022 soft patch where it came off 5 big points in the headline and then rebounded 5.5 big points in the headline. So market expectations for Fed policy sort of shifted a little bit, mostly on the data. Look, I think Fed Chairman Powell and most of the FOMC, and we do have new FOMC voters this year in terms of new regional Fed presidents, but the Fed governors certainly have been consistent with Powell, and that is this. Look, they've gone a long ways in raising rates, right? You know, we've got an overnight rate of about 4.58% to the middle of their 4.5 to 4.75% target, but they've really raised rates a lot over the course of the last year. First rate hike last year was in March. So they did roughly about 450 basis points worth of tightening last year, which is significant. But the fact of the matter is the economy is not slowing as they had suspected. And though there are signs such as some weaker average hourly earnings and things like that, though there are tentative signs of some disinflationary pressures come to the economy, for the most part, it continues to be about inflationary pressures and inflationary pressures that are not subsiding at a good enough pace or rate for policymakers to be confident that inflation will head lower and stay lower. And so the markets had to reprice on the back of it. And Powell and his team have been very consistent in saying, look, much like you, Mr. Market, we are data dependent. And as long as the data continues to be strong, the Fed is going to continue to raise rates 25 basis points out of clip. They're going to kind of slow down their pace, but they're still going to continue to raise rates. And they're going to keep rates higher than otherwise for longer than otherwise, which means that there's opportunity in these CME SOFR-based contracts and forward Fed expectations.
Yeah, that jobs number came in pretty hot. I think that spooked a lot of people. It seemed like, John, we were heading into for a while there that good news for the economy was going to be good news for the markets again, right? And then that news that might have been too good. It might have been a little bit too strong for everybody.
That's exactly right. That's exactly right. And the Fed wants to start to see sort of the whites of the eyes or really compelling evidence that inflation is not just falling, but falling at a pretty good clip and getting back to target. And they haven't gotten it yet. And the labor market has been the transmission mechanism mark by which overstimulative fiscal policy coming from Congress and coming from the executive branch has overstimulated the economy, too much money chasing too few goods in a post-pandemic world. And, we may have to go a little bit farther than what the market thought about a month ago.
Speaking of that market, John, looking here at these numbers, there was a question. I think then even the last time you joined me officially on this show, John, which was almost exactly a year ago, which is crazy. 1 day away from our 1 year anniversary, John. So we couldn't have planned it any better. But the last time you joined me, John, there was an open question whether the 3-month SOFR could really pick up the ball that Eurodollar was putting down and run with it. Looks like we have the answer to that question now, John. I'm looking at the numbers here for this week so far for the 3-month SOFR. And my goodness, they're putting up some numbers. 9.5 million contracts so far this week, John. That might be the largest total we've ever discussed on this show. These numbers are quite something, John.
Yeah, well, look, I mean, there has been a significant shift into SOFR futures contracts in general from Eurodollar futures. So, for example, right now in the quadra mark, you have 9.3 million contracts of open interest in 3-month SOFR futures, where Eurodollar futures have just over 5.8 million contracts. So SOFR's kind of sort of outperformed and outjumped. However, look, SOFR it's a fabulous contract. It is playing its role now, but I would suspect that in time, institutional users and end users of the contract will eventually come back to the CME group and see if they can sort of tweak the contract. Term SOFR is sort of one idea that I think is floating out there, around out there in terms of end user interest within the SOFR contract. And there are other alternatives that some asset managers are sort of looking at. I know Bisbee has some interest, and Ameribor is still out there as well. But really, it's SOFR. It's the SOFR contracts to lose, and it's still the winner in this transition away from LIBOR, listed LIBOR product. But there could be some tweaks, coming on up, and we'll see what happens. But so far, so good. Are
your customers over there, they're embracing it? Sounds like a 9.5 million contracts, John. Can't be wrong.
Yeah. No, our contracts our customers have certainly embraced it, but they'd maybe like to see, maybe some minor changes or tweaks to the contracts to kind of better cover, sort of some term risk, upfront and stuff like that. So we'll see what happens.
We shall see indeed as we dig into this hurricane of paper, listeners. Nearly 10 million contracts. Like I said, I don't think we've ever discussed a contract flirting with 10 million contracts before on the show. So we're heading into new territory here. By the way, if you're wondering how much is left on the old Eurodollar, it's about 330-odd thousand contracts. So clearly the ball is in SOFR's court and it is not going back. Again, of that 9.5 million, think about that, 9.5 million contracts, listeners. You can add up a lot of the other complexes we're going to talk about, and they don't even come close to spitting distance of this one product here. Almost exactly 25%, 24.5% of that just explosion of paper is going up in the near-dated SEP contracts here in SOFR. Let's see. You're hanging out right now. By the way, were you wondering where is this future? A little bit north of 95, almost 95.1 out there right now. In terms of vol, again, the rates complex not known for vol, except when you get out into the land of formerly the Eurodollar, now SOFR. You start to see some vol out there. In fact, an 84 right now in this contract. This contract is the SEP contract. It has 218 days to go. It's an 84 vol, up 12 1/3 points just this week. So your traditional equities hanging out shy of a 20 vol right now. And here we are, the SEP SOFR contract here at an 84. So a lot of juice to be found out here for those looking for a little bit of vol right now. In terms of skew, you're getting some action out here as well. The puts last week, 3% cheap. This week, 6.7% cheap. So the puts coming in. And the calls last week, the calls catching a huge bid this week. The calls last week, 5.2% premium to that already lofty 84 vol, listeners. You want to buy a 25 Delta call this week, it's going to cost you a 14-point vol premium over that already impressive 84 vol. So folks are piling into the calls. Let's go see what the hot contract was out here, listeners. And there was, man, this is a lot of paper here. The big dog, listeners, and I do mean big, Nearly 500,000 contracts, 446,000 contracts in this one put, the 94 half puts in the near-term September contracts here in SOFR. Man, just a unbelievable amount of paper. Monday, 48,000. Tuesday, Powell coming in, ginning up some action, 156,000. That one day alone is going to be more than some of the complexes we talk about a little bit later. We get on into metals and some of the other products. Wednesday, 173,000, and today, 67,000. Yes, a total of 446,000 contracts. The OI on this strike is 238,000. I mean, these numbers, you can't make them up, listeners. They're just across the board. Opening Tuesday and Wednesday, Monday closing. Today, obviously, we don't know, but just a stunning amount of paper. And then behind that, we have to actually scroll back a little bit to the March contract. Has about 29 days to go. We have the 95 and a teeny. Man, I haven't done that in a long time. 95 and a 16th puts. I love 8s and 16s still alive and well over here in the 3-month SOFR. And we have about 255,000 contracts, a little bit north of 250,000 going up here. 181,000 on Monday. So, man, they came for that. All opening. 40,000 on Tuesday, 34,000 on Wednesday, and then a whopping goose egg today. I love these contracts that can just turn it on and then turn it off on a dime. Not even a one lot today on these 95 and a 16th puts in March. Nope, 0 today, but just 250,000 the rest of the week. Again, you can't make this stuff up, listeners. And then going back out here to the SEP contract, our other most active contract out here, we have the 94 and 5/8. Again, throwing me back to my old SPX trading days, teenies and eighths. It's fun. 205,000 contracts here. The big day for those, actually Wednesday. So we're seeing some fluidity in terms of which days we're driving the paper. It's not all just Tuesday, or it's not all just Wednesday. It's kind of all over the place. And this strike, it happens to be Wednesday, 116,000 going up there, mostly opening, 55,000 today, 30,000 on Monday, mostly closing, and then 5,000 only on Tuesday. So again, very staccato trading, a huge amount of paper and then nothing. It's very interesting. Sean, I could probably go on the rest of the show just trying to parse the just absolutely ridiculous amount of paper. It is interesting once you get a little bit farther down the curve, though. And again, this term structure for 3-month SOFR goes out for many years. It starts to get a little bit quieter as you go farther out. But the near portion of this curve is just a tsunami of paper. Any of that come as a surprise to you, John? Is that kind of what you were expecting? And so any of these numbers surprise you?
Yeah, no, the numbers don't surprise me, Mark. It's good to see, right? I mean, look, there's opportunity in here. Hedge funds and all sorts of types of end users to the product have returned, to the product after a relatively quiet November, December. And look, there are opportunities. There are opportunities to sort of generate alpha, to generate return on the front of the curve. There's some mispricings, we think, in terms of the late 23, early 24 pricing within the market. It's the trade of lowest pain right now. That maybe Fed policy has to be recalibrated back there at those points of the curve. Look, there's opportunity out there. There are creative ways to sort of to take advantage of mispricings, and we've been lucky at our deal to be sort of involved in that trade, and it's good to see a lot of end users coming back in to the market and utilizing this great product to either hedge exposure or to express market views.
Probably why we're seeing so much paper in that SEP contract. Taking advantage of those mispricings there, as you say, John. What do you say? Since you're a rates guy, a lot of rates action, what do you say we keep hanging out the rates for a little bit longer? How's that sound, John?
Sure.
Are you a big 10-year man? Should we go there next?
Yeah, I don't mind the 10-year. I mean, look, got a strong auction yesterday, right? We had a 10-year cash auction that kind of came 3 basis points through, Mark, on very strong demand. Chatter out there, loose market chatter, is that some of these relative value hedge funds have sort of reappeared as well. Now, you remember those relative value hedge funds that were run during long-term capital management.
Old school, yeah.
and ahead of the global financial crisis, whatever. So there's been sort of some market talk that some of these relative value hedge funds are kind of back in the market, sort of participating in the old ARB, which was kind of taking advantage as accounts kind of have to kind of roll out of existing 10-year notes to buy the new 10-year note, where the existing 10-year note tends to cheapen a little bit on curve. And so, relative value hedge funds kind of like to do that. They kind of like to take advantage of that cheapening of the current issue and maybe sell the expensive WI issue and then watch those two issues converge. So there's been some market talk that trade is kind of back in vogue a little bit. And so that's kind of, been one driver, I think, of what's gone on in the auction cycle. There is chatter too that, institutional overseas investors are kind of taking advantage of some of these yield dynamics within the U.S. Treasury market now, especially as, well, before last Friday at least, it kind of seemed like maybe the Fed was kind of closer to the end of their cycle, which means opportunities within cross-currency basis swap trades and things like that. That may reprice a little bit. But no, the 10-year was a very strong auction this week and very impressive, unlike today's 30-year. But please, by all means, Mark, take the microphone.
All right, 10-year we go here, listeners. And by the way, 10-year, usually one of the more active products you talk about. And it certainly is putting up some numbers just when you see it in the context of what we were just talking about with 3-month SOFR. It shines it in a little bit of a different light. Closing in on 3 million contracts, about 2.7 million contracts right now, but still obviously less than the third of the 9.5 million we were just talking about in 3-month SOFR. So that 3-month SOFR just off to the races right now, listeners, from a volume perspective. But still, the 10-year, nothing to sneeze at. Where is the 10-year hanging out right now, listeners? Right about a 113, even in that front future out there. In terms of action, a little over half, about 53% of that 2.7 million contracts going up in the March contract that has 15 days to go. So you're talking a very near-dated paper here in the 10-year. People are not going out for a long time. They're here for a good time right now. And in terms of the vol, now this is getting back to the vol levels we all know and love out here in the rates complex, which is not much, listeners. A little bit north of a 7, about a 7.15. That's up about 0.6 of a point. So that's not nothing in terms of movement out here. When you're starting at a pretty low baseline, that's a pretty impressive move. But still, net, you're talking about a little bit north of a 7. So not a ton of vol out here, and certainly a lot less than the 3-month SOFR we were just talking about. Skew-wise, as to be expected, not a heck of a lot going on here. Most of the wings are pretty much flat, half of a point either direction or so. So not much to sink our teeth into there. Instead, we'll look at some of the paper and see what's lighting up. I said we're at about a 113 even. And that front future, the March future, also hanging out at about a 113. And we are, in terms of most active contract out here this week, it was the 112.5 put. So pretty much an at-the-money put at that point, doing 153,000 contracts this week. The big day was Wednesday, 80,000 on Wednesday, a lot of closing. So some folks taking a lot of 112 puts off on Wednesday. We saw 45,000 going up on Monday. That's opening. So opening going into Powell's speech, closing the day after it. Probably not surprising out there. 18,000 on Tuesday, only about a little bit less than 10,000 today. And then right behind it, we have, looks like the 112 put. So a nice little put strip going up here. 116,000 of those. That one, actually, the big day was Tuesday. So that's kind of interesting. Almost 50,000 going up on Tuesday, mostly opening. 36,000 on Wednesday. So that was closing. And 20,000 on Monday. 14,000 today. So opening earlier in the week, closing on Wednesday. Today's paper, not a ton. So intriguing. A little bit of a different volume pattern there. And even though it's only a half a strike different. Fascinating. And then right behind that, we have the 113 puts. So these are literally our at-the-money puts now. 99,000 of those. We have the big day for those was Monday. So that's interesting as well. The big day for the 112 half puts was on Wednesday. The big day for the 112 puts was on Tuesday. The big day for the 113 puts was on Monday. So we're kind of all over the place when it comes to 10-year puts here, listeners. 35,000 going up on Monday, 30,000 on Tuesday, 18,000 on Wednesday, 15,000 today. It was like opening throughout the week. So again, not surprising. This is our at-the-money strike right now. So not surprising to see some paper flying fast and furious over there. Let's scroll a little bit farther to see if we can see anything else that's interesting and or aberrant. Looks like the 112 puts were pretty much where the action was. We had 33,000 of those going up in April, also 16,000 of them trading in June. So 112 puts kind of the trade, the option, the strike du jour out here this week, listeners. As we keep on rolling, let's get on out of rates. And a lot of action to be found. I'll let you choose our next complex, John. You want equities? You want metals? You want energy? You want something else? What's floating your boat?
Let's go with equities.
All right, to the world of equities, we go.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to the wonderful, the sometimes mystifying world of equities. Pop on out of that, rates drop down, go up 2 slots to equity indexes. Then we're going to hang out in the U.S. index. From there, where we go, it's anyone's guess. But John, this has been I think fascinating is one word to call it. Topsy-turvy roller coaster, call it what you will. It's been a very tumultuous equity market ever since Powell really kicked things off last week and kept things kicking this week with his comments. What are your thoughts on what we saw with the market's, shall we say, optimistic reaction to Powell? And even in the early blush after the jobs number on Friday, they still tried to rally it. It's just, it's been fascinating to watch. What are your thoughts on this market post-Powell here, sir?
It's been a flow trade. It has not been a fundamental trade, Mark. Earnings reports have come in pretty disappointing. Margins continue to contract as we are seeing kind of pockets of product disinflation. Not service disinflation, but product disinflation. So that kind of has a negative effect overall on corporate margins, operating leverage continues to come off a little bit. And it doesn't make sense to us, even with today's sell-off here, both E-mini and NASDAQ futures. The NASDAQ's still up 13% for the year. The S&P 500 is still up over 6.6% for the year. If you annualize those numbers through the first 6 weeks of the year, and you've got 52 weeks of the year, and you multiply it by 8, I mean, the S&P is still on target to be up 48%, almost 50% on the year. And you take NASDAQ, and NASDAQ would nearly double if we just kind of stayed on pace between now and December 31st. So some of us out there, it doesn't make a whole lot of sense, specifically kind of what earnings are doing. So we think much of January, the run up in January and into February, Mark, was very much of what was a flow trade, and that really has to do with capital and money that was on the sidelines that went to work early in the new year, following a difficult 2022 for sure. The 60-40, balanced portfolio, the market aggregate was down 14% on the year in 2022, the worst year ever. And so a lot of this money that was on the sidelines for November, December came back to work in January and drove the market really to levels that I think is unsustainable. And you're seeing it. So you're exactly right. After March E-mini contracts kind of made a run at 4,200 and failed technically. Right now, as we speak, they trade 4,100. And we think there's a pretty good chance that we at least have to have a little bit more digging and work to do on the downside over the course of the next 3 to 4 months, as the market needs to kind of price in a little bit more realistic earning expectations for the rest of the year. And Mark, price in probably maybe a little bit more of an aggressive Fed. Much of the trade in January too, with the run up in equities, had to do with sort of a belief that the Fed maybe had one more interest rate hike, no more than 2 left in it. Well, last Friday's numbers sort of changed that calculus. The Fed has probably 2 more hikes in it, and maybe 3. And equities have to adjust to that phenomenon as well. All you're doing is discounting back forward earnings from a higher discount rate. Should the Fed keep going up, keep raising rates, and so that's kind of the simple math to it all. But equities remain vulnerable to a downside trade here, we believe.
Yeah, that jobs number really kind of the nail in the coffin for a lot of the optimism out there. I know. Speaking of optimism, or perhaps the lack thereof, John, I know when you joined us in the Pro Q&A hot seat, I believe it was October, November of last year in that time frame. I know you were at that time extolling the virtues of cash for a lot of obvious reasons. Are you still on that sideline with a lot of your clients? Yeah, cash is king right now?
Yeah. Well, look, I mean, cash has, Mark. Cash has optionality.
Optionality. I like that term, the optionality of cash. Yeah. You're one of the first to bring that up. Yes.
Right. And so, look, we think there are opportunities there, in terms of just holding cash to take advantage of maybe kind of rather dramatic market dislocations or market repricings. Look, there is absolutely nothing wrong with holding a 6-month T-bill that yields 4.90%. It's almost 5% guaranteed. Right. And this year, the industries could well deliver more than 5%, Mark. They could, but it's not going to be easy. And I don't think it's going to be a straight line the way the month of January was. And so I kind of think that these are times where you can get paid to be patient. And I think that's a little bit of the trade, especially as we start into 2023. Yes, sir.
We'll see how much patience or perhaps lack thereof we have here in the E-mini right now. A very active week. But again, when we start with the 3-month SOFR, it puts everything else in an interesting context. The E-mini closing in on 3 million contracts right now, listeners. 2.9 million, obviously still less than a third of the 9.5 million we were just talking about. You can have a full 3x of what we're talking about here and still not equal the volume going up in that 3-month SOFR. That is just an incredible amount of paper. As is always the case with an equity, listeners, especially these days, the lion's share of the paper is all going away today or tomorrow. Equities are no longer long-term vehicles, it seems like, out there. Right now, hovering a little bit north of 4,100 in the S&P, still off about 41 handles on the week, about 1%. It's a lot to unpack out there in these markets, the ever optimistic, except for today, markets out there. In terms of action, once we sort out and sift through the nonsense like the 3,500 puts and the 34 half puts that are going up for 40,000 contracts at a clip, we can dig through to some more relevant contracts. How about the 8-day to go 40 half puts, the 4,050 puts, listeners? These are pretty active actually this week, doing about 34,000 contracts. Again, these are the Febs expiring in 8 days, so a long time from an equity perspective. Doing a lot of paper. The big day for those was Wednesday, though. 24, almost 25,000. So the lion's share going up on Wednesday. The other 8,000 kind of scattered throughout the week. Opening on Wednesday, so clearly a lot of folks piling in to these puts here on Wednesday and just opening for a pretty large chunk of size. Let's go back here really quickly and see if we can see any other near-dated stuff beyond just the nonsense puts. Yeah, the 40 half puts also pretty active with 1 day to go as well. So those are pretty active this week. They did about 21,000 contracts here, trading about 5,000 to 6,000 contracts a day pretty steadily. Opening looks like throughout most of the week. So 4,050, that seems to be the put strike du jour here in the E-mini this week. Not to be outdone, there were some calls trading. The 4,200 calls, these go away tomorrow as well. They did about 22,000 contracts. The big day actually today, 8,000 today, about 5,000 yesterday, 6,000 on Tuesday, almost 3,000 on Monday. Opening throughout most of the week. We obviously don't know about today's volume. And also, not to be outdone, the 4,000 puts, also pretty active. These also going away pretty much tomorrow. They did about 20,000 contracts. The big day for those, Tuesday, about 7,000, 6,000 on Monday, about 5,000 yesterday, and a little north of 2,000 today. So there is some other paper to be found besides the nonsense puts. You just got to dig for it a little bit. Let's go a little bit farther out. 4,000 puts also pretty active out here at the end of February contract, doing about 13,000 out there as well. And or aberrant puts in these contracts going out in about 4 days. That's also a very popular time frame for a lot of equity folks out here right now. While we wait for that to load up, I'm going to keep scrolling through, see if I can see right when I want it here. Let's keep scrolling. But yeah, it looks like the lion's share of that action, such as it was, is very near dated as you would expect, and mostly hanging out around that 4,000 to 4,200 put strike. Worth noting, the March 3,800 puts did do 16,000 contracts this week. Here we go. Now my machine's catching up with me here. The 38 half puts going out in 4 days did about 6,000 contracts this week. And the 4275 calls doing about 7,000 contracts, about 2,800 of that today. So there is still some upside going up out there, listeners. It's just coming in fits and starts out here. Let's go really quickly, scroll down. Want to get really optimistic, listeners. The Jan 5,500 calls traded 250 times this week. It's like it's a 4,100, 4,400, 5,500. It's not even a fly at that point. It's just pretty much a funky strip out here, but all doing about 220 to 250 contracts all on Wednesday. So there you go. That's your kind of oddball paper here for the week. Speaking of oddball paper, it's moving around a lot. So I think we got to head out into the energy complex next.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners, welcome to the turbulent world of energy out there. Go into that drop down, pop out of equity indexes, go up one slot to energy. And then from there, it's kind of a pick your poison of where we should start. John, I know when you're not talking rates with your clients out there in equities, you're probably talking a little bit of energy over there as well. It's inescapable. I mean, we had our guest on the show last week, Dan Grams, and he and I were just wringing our hands at seeing a two handle again in nat gas. Back a few months ago when we were talking 7, 8, 9, 10 plus calls going up for size, no one thought we'd be seeing a two handle again. So Certainly fascinating stuff. John, what's lighting up the tape at RJO over there in the energy complex these days?
Well, certainly, sell-off in nat gas has certainly caught our attention, but also too, there's been a steadying in the crude sector, Mark, and so there's been a lot of political rhetoric, within the news cycle about corporate profits from these energy producers, and government officials suggesting that perhaps profits and share buybacks should be taxed. Makes for great political sort of grandstanding on national TV on any given Tuesday night. But at the end of the day, as it relates to markets. And this goes directly to the interest rate question. It goes directly to the equity question, and that is the widening out of crack spreads. So whereas crude oil has been relatively steady between, let's call it $75 and $85 a barrel, relatively steady, refined gasoline and finished crude products are catching a bid. And what that tells us is that the economy is not slowing down. The economy is not entering a recession. There is both consumer and institutional demand, manufacturing demand for refined and finished crude product. And so that's sort of been a trade that we've sort of been involved with, long crack spreads, with the idea that end user demand has yet to roll over here in the U.S.
Now, let's get to that and see what kind of demand we're seeing out there. WTI, obviously, our number one light side mover this week, such as it was a light side week, pun intended, up 2.6%. WTI coming into this segment of the show, nearly a 78 right now, about 77 3/4. Puts it up about 4.3 handles on the week, or about nearly 6% just since Monday. Obviously, you go back to our show last week, a little bit less. So let's see. And how much paper on the tape? About the amount of paper you would expect. You usually expect this time of the week, an average week, somewhere around 440,000 contracts in WTI. And we're almost exactly at that right now, 436. So a pretty average week out here from a volume perspective in WTI. What is interesting, though, is that it's very much trading like an equity right now, with 43% of that paper, 43% of that 440,000 contracts going up. And the March contract, that has 6 days to go. So a lot of folks wanting their near-dated exposure here in WTI. Let's go see really quick. That is the March contract. That is at about a 77 3/4. The vol out there at about a 36. Listeners, off about 5 3/4. So the vol coming in this week. The skew, the puts this week. We'll also go check the April time frame as well, because we want to go a little bit farther out as well. The April vol on the April contract, that did about 17% of the paper this week. So far less than the March, but let's look at both of them. That's vol is a 37 1/4, off a little over 4 points out there. Let's see, in terms of skew, the puts in March, again, there's only 5 days to go, 6 days to go. So take it with a bit of a grain of salt. The puts 2% bid last week, 4.5% bid this week. And the calls about 1% cheap last week, now nearly 4% cheap. So the puts getting bid, the calls coming in. That's kind of interesting. And then you're going out a little bit farther, going out to April, so a whopping 35 days. Puts nearly 4% bid last week and about 4.3% bid this week. And the calls 3.1% cheap last week, 5.3% cheap. So you're talking net, the skews are similar, a little bit more of a discount to the calls out there in April. And what was the big dog out here this week, listeners? It was the 70 puts going away in 6 days in March, doing 26, almost 27,000 contracts. The big day was Monday, 9,300, 6,600 on Tuesday, 5,300 on Wednesday, 5,400 today. Only day that was really opening was Tuesday. That was slight. So it looks like a lot of folks were unwinding their 70 puts, which again, we're rallying this week, moving away from the 70 strike. These go away in about 6 days, makes some sense. And maybe you want to get what you have left in terms of premium on these puts while the getting is still good out here. So that could also account for what we're seeing, even though those puts did catch a bid this week. So that's kind of interesting. Maybe some buyers coming in to close out those puts. Either way, intriguing stuff here. Right behind that, we have, looks like the 85 calls. So it's not all puts all the time. It did about 13,500 contracts. The big day was today, 6,100. Hot on its heels. Yesterday, we had Wednesday, about 5,800 contracts. Tuesday and Monday, kind of light out there, only about 1,500 contracts between them. So most of the Wednesday paper yesterday and today. And then going beyond that, we go out to, looks like the 90 calls. These are actually in June for number 3 here. These did almost 13,000 contracts, 12,600 to be precise. The big day was yesterday, 6,500. Today, 4,000. 1,600 Monday, and a couple of hundred on Tuesday. So again, looks like mostly opening throughout the week on the 90 calls in June. You like those, listeners? Would you rather buy those or would you rather sell? The 90 calls in June. Not to be outdone, we go all the way out to December, listeners. We got the par calls going up 4,600 times. Looks like that was straight up. Doesn't seem like it was against any other verticals. Looks like they did, but 4,600 times. The big day was Tuesday, 2,300, so pretty much half. About 1,000 on Wednesday, almost 1,000 on Monday, and a few hundred going up today. So opening paper throughout the week on the par calls in December. What do you like better, the 90 calls by June or the par calls by December? Do you not like either of those? Would you rather sell both of those out here, listeners? I'm curious your thoughts here. And before we roll on out of energy, let's go check in really quickly with Nat Gas. John, you mentioned this kind of two-handle. I think it's caught a lot of people by surprise out here. Given how tumultuous this past year was for Nat Gas, certainly since the invasion, which was almost a year ago, almost our anniversary of your last appearance on the show, John. Have you seen a lot more clients maybe piling into Nat Gas over the last year as a result of that volatility? Or has it been just too scary to take their ball and go home?
Yeah, no, I think it's the volatility has scared off, certainly, some liquidity providers and sort of the day trader types, Mark. But look, at these types of levels, we are starting to kind of see kind of more end user institutional account type receiving of these contracts in Nat Gas, because if you can kind of hold it through the course of the year, the bet there is that the war in Ukraine will not be finished by this time next year. This has been an unusually warm winter, both here in North America and in Europe. And so down here at these types of levels, you have a lot of bad news within Nat Gas priced. And there's enough going on both geopolitically as well as on the infrastructure scene here in the United States that kind of could give Nat Gas a bid. What do I mean by the infrastructure scene here in the U.S., right? Well, for example, heating bills in California, if we know what the price of natural gas is, heating bills in California are 2 and 3 times our normal rates right now. It's a little bit of what we would call a sticker shock to those residing in California. But California does not have storage. They don't have storage facilities for natural gas. And so when you had a very wet and damp January in California and natural gas demand was stronger than otherwise, because there was a lack of storage facilities, the state of California, PG&E, had to go out to the open market and bid up for supplies. And so the lack of infrastructure in California, for example, this year, has been an example how, on a simple regional basis, natural gas has traded much higher than what the market implies. And so at these types of levels, we think there's a lot of bad news priced into natural gas, and that should the war in Ukraine either intensify or continue as is as a stalemate, that the odds of next winter perhaps being a little bit more normal, reverting to the mean, versus this year's unseasonably warm winter are higher than otherwise, and we think that the price reflects that. Or doesn't reflect that, does not reflect it quite yet.
Yeah, kind of hard to argue with that with a 2.5 handle less than that right now in front month Nat Gas. By the way, I said WTI, kind of an average volume week. Not so for Nat Gas. Nat Gas put up some numbers this week. Nearly 600,000 contracts on the tape, about 575,000. So that's a pretty robust week for all things Nat Gas. And of it, once again, trying to do its best equity impersonation. The March contract that has about 14 days to go, doing 32% of the paper. Where is March Nat Gas? 245 right now, listeners. So still hanging out a little bit shy of that 2.5 level. What are your thoughts on these levels here in Nat Gas? You think all this bad news, like John said, is really being reflected in these prices, and maybe you want to buy more? You think there's more to come? I'm curious. What are your thoughts out here in Nat Gas? I've seen a lot more of you get intrigued by the space than maybe you would have in the past, just because there has been so much action and it has been so beaten down over the last few months. In terms of vol, this front month vol, getting back to these levels we know and love out here in Nat Gas, which is flirting with triple digits, listeners. A 95 right now, pretty much unched on the week. So, and again, it's hard to argue it's not warranted. Nat Gas has been moving. This week is kind of the quieter week. If you expect the vol to collapse, maybe it would have been this week. It didn't really do much. But in terms of skew, we have the puts last week, 5% bid. This week, catching a bid up to about 7.5% bid. The calls actually coming in a little bit. They're about 3% cheap this week, about 1.1% cheap. So bid for the puts growing and the discount for the calls decreasing, which is kind of interesting. And in terms of action, it was the 2 puts. Again, that strike has been the strike du jour. It seemed ridiculous not too long ago when we were hanging out at a north of 6 or 7 handle, and we saw these strips of puts of 2s going up. It seemed absurd, and now they're not that far away from at the money. The 2 puts going out in 2 weeks, so the March puts doing a ton of paper, most of it today, actually. Of the nearly 50,000 contracts going up on the strike this week, almost 22,000 going up today, so nearly half. And then we have about 14,000 on Tuesday, 8,000 on Wednesday, 3,000 on Monday, opening all week long. So more people continue to pile into these 2 puts. That was the case last week. That remains the case again this week. So you're thinking, and again, that put bid also growing out there in terms of premium. So if you're thinking the sell-off is out of steam, allow me to present a whole bunch of 2 puts, maybe arguing in the other direction here. So intriguing stuff. Obviously, some folks could be concerned. They want to lock in, they hedge themselves against ever further sell-offs. I can't blame them. But still, clearly, a lot of demand for these 2 puts out here. Also, right behind it, we have the 1 3/4 puts of 2 puts. Not out there enough for you. The 1 3/4 puts doing about 21,000 contracts. The big day was Tuesday, nearly 10,000. 5,000 on Monday, about 4,000 on Wednesday, and about 2,300 today. Slightly closing on Monday, opening the rest of the week. So still a lot of downside going up here, listeners. And again, that volume, the increasing bid on the put wing showing not done buying puts out here in NatGas. That may come as alarming news to some of you out here, but I'm just telling you the numbers as I see them, listeners. Let's go out here a little bit farther. Let's go to April. That's actually a lot farther. That's 47 days compared to 14. Got the April 2 puts also active there, about 18,000. The big day also today. Today, a big day for 2 puts in NatGas, listeners. Almost 8,000 going up today. 4,000 almost on Monday, the same on Tuesday, and about 2,300 on Wednesday. So back and forth throughout the week, but obviously a lot of paper going up here. And then here's the strike we've all been waiting for, listeners. The May 1 puts doing 12,000 contracts this week. Almost 8,000 today, 7,400 today, 2,300 on Wednesday, 2,100 on Monday, and a couple of hundred on Tuesday. The 1 puts. I did not think we'd be talking about a 1 handle, listeners, when we were talking about much higher handles and call paper for size. They 1 puts have been trading. Also, 1 puts going up here in the October contract as well, almost 12,000 there. So, I mean, it's not all puts all the time. You can find some calls. The 5/2 calls here in August went up 5,000 times this week. Almost all of that today. I have no idea what they were doing with those, but so there were some calls printing. August 5/2, you like those, listeners? Someone putting on those. Also, the 5 calls going up in November, 6,000 times. Most of that today as well. 7/2 calls going up 1,000 times. These are January of next year. 7/2 by this time next year, listeners. That would be interesting. But man, a lot of just a whole ton, I think, is the technical term of downside. Still lighting it up out here in all things NatGas. All right, listeners, that music means we've come to the end of another journey. John, we didn't even get to, let's say, metals, some of the other stuff. It was a very crowded week this week, sir, but a lot to parse. You picked a good one. If you weren't going to come on back for a year, John, you picked a good one to come on this week.
Well, Mark, thanks for having me back. I appreciate it. It's always a pleasure to talk to you.
And John, if folks are intrigued, they want to reach out to you or the team, I should say, over there at RJO, talk about any of these products in more detail, how should they go about it?
Give us a call, 312-373-5000, or reach out to us via email or go to our website. But we're always here, and we'd love to talk to you.
There you go, RJ O'Brien. You know how to find them. Pretty easy to find them. Reach out, just ask for John, and he'll ease you into all of this fun with rates, 3-month SOFR, maybe some equities, maybe a dash of metals, maybe a sprinkling of energy on top, and all sorts of other fun. Of course, if you want more fun, and who doesn't, you know where to go, cmegroup.com/TWIFO. That's the place to go to access all these reports. Remember, these are running all the time for your listeners. So if you want to check what happened this week in NatGas, let's say Sunday at 2 a.m., it's there for you. We don't judge. cmegroup.com/TWIFO is the place to go to begin your journey to the dark side. Just watch out. There's a lot of data there. You can get sucked down a rabbit hole. Next thing you know, you're 3 hours later. But you've done some good stuff, so it's not the worst thing. Not the worst rabbit hole you can get sucked down. That is going to do it for us on the network today. Listeners, back again tomorrow, noon Central, 1 p.m. Eastern for Volatility Views. Got some great guests joining us to parse this mad week of volatility. There's something to talk about. After that, for all you cool cats in the secret club, we'll be back for Options Oddities afterward. And then back again next week on Monday, kicking it off with the old OB all the way through to next Thursday. Another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.